What's good, y'all? Welcome back to the channel. I am currently at work. It is currently 3:30 in the morning, and I'm deciding to make this video right now. I feel like we have a nice little setting right here, nice little aesthetic. It's Christmas, it's festive holidays. Uh, word. I'm breaking down some of the most important keywords in trading, from basic beginner terms to advanced concepts that every serious trader should know. Understanding these vocabulary words will help you read the markets, follow strategies, and level up your trading knowledge. This is not financial advice, this is for educational purposes only. Let's get into the video. Paper trading. Practice trading with fake money. This is where traders test strategies on simulated accounts. Day trading. Buying and selling within the same day. Day traders aim to profit from short-term price movements and avoid holding trades overnight to limit risk and exposure to after-hours news. Market. The place where assets are bought and sold. The market is the environment where prices change based on supply and demand. Bid. The highest price a buyer is willing to pay. It shows buying interest and sets the demand side of price. Ask. The lowest price a seller is willing to accept. It shows selling interest and sets the supply side of price. Broker. A company or platform that executes trades on behalf of traders. Brokers provide access to markets, tools, charts, leveraging, and they may charge fees, spreads, or commissions. Each broker is different. Spread. The difference between the bid and the asking price. Smaller spreads means cheaper to enter the trade and is more efficient for trading. Order flow. This is the info showing where buying and selling pressure is coming from. You use order flow to see what big players are doing, anticipate price movement, and trade in the direction of smart money. Volume. The total number of shares or contracts traded. The higher volume means stronger activity and more reliable price moves. Volatility. How much price changes over time. More volatile means more risk, but it's also more profit potential. Liquidity. How easily an asset can be bought and sold without price impact. High liquidity prevents slippage and makes trading a little more smooth. Bull market. A market that's moving upwards. Investors are confident, demand increases, and price trends upwards. Bear market. The complete opposite of a bull market. A market that is moving downwards. Investors are fearful, demand drops, and prices trend downwards. Trend. The general direction of price movement. Following the trend increases the odds of profitable traders. Short. Betting that price will fall. You sell first, buy back later, and you get the profit from downward moves. Long. Betting that price will rise. You buy low, sell high, and you profit from upward trends. This is usual investing. Market order. A request to buy or sell an asset at the current price. Orders tell the broker what to trade, at what price, and when. Limit order. A set action to buy or sell at a specific price. Position. The trade you currently own, long or short. Position stays open until you close it and take profit or take loss. Stop loss. An automated order that closes a losing trade. This prevents emotional decisions and larger losses. It's a safety net. Take profit, opposite of a stop loss. Take profit is an automated order that closes a winning trade. It locks in profits before markets reverse, losing your profits. You can think of take profit as a finish line. Hedging, protecting a position by taking the opposite side. This protects gains or reduces potential losses. Pretty much having both a buy and a sell at the same time, protecting your position. Support, a price level where buyers tend to step in, often leads to bounces or reversals upwards. Resistance, a price where selling pressure kicks in, often stops upward movements, causing price to fall downwards. Breakout, when price moves or breaks beyond a key level. This often leads to a strong follow-through into that direction. Pullback, a temporary move against the trend. Most people wait for a pullback to enter any trade, whether it's a long position or a short position. You wait for a pullback in the opposite direction. to then ride that trade down. Reversal, a change from an uptrend to a downtrend, or vice versa. Signals that the trend has ended or it's becoming weak. It's probably time for a reversal. Slippage, when a trade is executed at a worse price than expected. This usually occurs when there's high volatility, fast movements in the markets, and your order cannot be filled at the requested price because the markets are moving too fast. I've been victim of that. It's not the best. Position size, how much capital you used in a trade. Having a set risk to reward ratio is how you manage risk in your trades. Risk to reward. Risk to reward is a ratio comparing potential gain to potential losses. It helps determine if a trade is worth taking. P&L, your profit and your loss. You could look at this like your KD ratio for all my gamers out there. It shows how much money you've made or lost on your position. Trailing stop loss. This is a stop loss that moves with price. It follows price so that profit is protected, allowing profits to grow while still managing risk. Leverage. This is when you borrow money to trade bigger sizes. It amplifies gains and your losses, so it can increase risk dramatically. Margin. Margin is just money borrowed from a broker that you use to trade. You usually have to maintain a minimum balance or face a margin call. Drawdown. Drawdown is the drop from peak account value. Let's say you enter a trade and the trade goes sideways on you, and now you're negative from your entry point. That's drawdown. We don't like drawdown. We tolerate it, but we don't like drawdown. Moving average. Moving average, or MA, is the average price over time. And this indicator smooths out the noise and it really highlights the trend's direction. Relative Strength Index, or RSI. This is a momentum indicator that measures overbought from oversold. It measures if price is too high or too low relative to recent trends. MACD, an indicator showing momentum and trend changes. It identifies shifts that may signal reverses. Volume Weighted Average Price, or VWAP. The VWAP is the average price by volume. Institutions buy and sell around the VWAP. FOMO. FOMO is an acronym in the trading world that means fear of missing out. This FOMO makes traders chase trades, and it usually doesn't end up well for them. Revenge trading. Emotional attempt to recover losses. This usually leads to poor decisions, oversized positions, and bigger losses that are driven by frustration rather than strategy. Backtesting. Backtesting is testing a strategy using historical data to evaluate performance. This helps traders test strategies before risking real capital, real money. Discipline. This is one of the more important ones because this is the ability to consistently trade a plan over actions influenced by emotions. Discipline is the key to success. If you don't have discipline, you don't have trading. If you don't have trading, you don't have discipline. If you don't have discipline, you don't have trading. Yin and yang, yin and yang, yin and yang. Scalping. This is quick trades for smaller profits. It requires high volume, precision, and fast executions. Swing trading. I wouldn't say the complete opposite, but it's the opposite. This is when you're holding trades for days or weeks on end, focusing on larger price movements, not entry day noise. And a little bonus one in there for y'all. We got stop hunt. What's a stop hunt? Now, a stop hunt is the manipulation of price to trigger stop losses. Now, this is OP. I can't even lie. Big institutions, your people with big pockets, right? They take positions not to make money, but to purposefully stop other positions out of the market. An example of this happening is price has a large wick down, and this large wick is solely purposed to stop people's positions. The best way I can explain this is it's an attack. It's literally an attack from big pocket people, big institutions that have the big plan to push price in any direction to where they assume a majority of traders will have their stop losses. And this stops out a majority of traders, and you usually see price reverse back into the other direction, a pullback. And that wraps up today's list of keywords. Remember, this is just a foundation. Remember to always do your own research, keep learning, never stop sharpening your sword as a trader. Learn, learn, learn. I appreciate you for watching, and I'll see you in the next video. Yeah, feel me? And I almost forgot, I do have a Discord server, so if you want to learn how to Discord, I have a Discord community that I will be putting in the description down below. Join up. I go live every Tuesday. You can watch me trade and yeah, learn together. Peace out. Oh shit.